The idea is you create a narrative. It doesn't have to be true. In fact, most of them are not true. Could be true, but that would be almost like a coincidence. But you create a narrative and people want to believe the narrative. They need an explanation for things that are inherently complex. And if you can give them a story that hangs together, they'll believe it. So what's the Wall Street narrative? The pivot, the famous pivot, right? They started talking about the pivot 2 years ago in the summer of 2022. Right. They say, well, the Fed's not done raising rates, but they're getting close to done. And as soon as they are, they're going to pivot to rate cuts. So they were calling for rate cuts in the fall of 2022. The Fed wasn't done raising rates. Turned out to be July 2023. We didn't know it at the time. They could have raised more, but that was the end of it. That was the so-called terminal rate. I mean, just as a quick aside, what's the terminal rate? Well, they define it as the rate which is high enough to bring inflation down on its own without further hikes. That's the terminal rate. They made that up. Who says there's such a thing as a terminal rate? The markets are highly dynamic. The inputs change all the time. The parameters change all the time. Who says that a terminal rate even exists? But the narrative is we're at the terminal rate. So by September, last year, it was like, okay, they probably are done at this point. It's been wrong for 2 years.
Right.
If you want my view on the Fed, they're impotent and irrelevant. But I watch them and I watch the press conferences and I write about it. But if you ask me if they matter, the answer is no. But see, if everyone else thinks it matters, you have to think about it so you don't get run over by a train. Meanwhile, what's actually going on with inflation? Let me explain how I look at inflation. The Fed is always wrong. They're always behind the curve. They're the last to know. When the Fed does something, everybody already knows whatever it is they're going to do in response to whatever just happened that they didn't see coming. So that's the Fed. Will they cut rates at some point? Yeah. They say they don't pay attention to politics. That's nonsense. They're very political. They're not going to cut rates 5 weeks before an election because they don't want to take sides. You can argue both ways. But here's the point. When they cut rates, and they will at some point, it'll be because we're in a recession. The data's there, it's undeniable, and oh, gee, guess we better cut rates. It's a wake-up call from the real economy. It's not, the Fed doesn't lead the economy, the Fed follows the economy.
Yes. As
a forecasting tool, it's awful for that reason alone. Why on earth is the pivot a good thing? Why is Wall Street rallying on a pivot? If you get a pivot, you're in a recession. That's why they would cut rates. The White House has been saying prices are coming down. They have not been coming down. You can find 1 out of 48 CPI components maybe, but prices have not been coming down. Inflation has persisted. What they mean to say, and I don't know if they actually don't know the difference or this is just propaganda.
They don't.
I think you're right. They mean to say the rate of inflation has been coming down. That's not the same as prices coming down. If the rate of inflation comes down, prices are still going up.
Right.
They're just going up at a slower rate. So saying prices are coming down is just either nonsense or a lie or propaganda. Take your pick. It's just wrong. But they're not even right about the other thing, saying the rate of inflation is coming down. That's not true because it's been going up. The bottom was June 2023, and it was 3%. That was the bottom. Then by August and September, it was 3.7, backed off a little bit, it was 3.4, and yesterday it comes out at 3.1. I'm sorry, 3.1 is higher than 3.0. Inflation, I'm using headline CPI, year over year, which is how they do it, is higher today in the last print than it was last June. So inflation isn't even coming down, it's going up. The Fed is losing the war against inflation. So forget about your pivot. Forget about terminal rate. Actually, inflation is going up. Now, if you want to be kind and say, okay, it's kind of sideways with some volatility, fine. That's another way to put it. It is not going down. So then they do core, take out energy and food. Energy and food.
Yeah.
The two things that most people spend most of their budget on, if you include home heating and air conditioning in the energy component, in addition to gasoline. So energy and food, take that out. That's what most people spend most of the money on. And that looks a little better. And then they have super core, which is let's take out energy, food, and housing. Unless you're living in a tent eating canned tuna and not going anywhere, none of that stuff applies to you.
No.
People pay CPI. CPI is what everyday Americans pay when they wake up in the morning until they go to bed. That is the most politically potent one because that will affect people's votes. I look at CPI headline because it is the thing that affects behavior. It is the thing that's going to affect how people vote in the election. And if mainstream economists and Fed, Regional Reserve, Fed presidents and others don't want to look at that stuff, that's their problem.
Right.
Mine. The price of gas at the pump and the price of milk in the supermarket. That's the essence of it because, okay, maybe, at the end of the Trump administration, gas was $2.25 and then it went up to like close to $5. Maybe it's down to $4.50 and the White House is crowing about going from $5 to $4.50, but it's up from $2.50. That's the point. And the other thing is this inflation is embedded. Even if inflation went to zero, it's not. Okay, but even if it did, hypothetically, that's not a price cut. The cumulative price increases that we've already experienced are embedded. They're locked in. They're not going away. And that still annoys people, even if inflation came down, which it's not, it's going up, as we just discussed. Those price increases are there probably forever. And that's what people remember. Inflation has a life of its own. It's behavioral. What drives inflation? It's human nature. It's behavioral psychology. You can look at expectations. It's a data point. But basically, it's also the supply chain. A lot of it's coming from the supply side. We're seeing minimum wage increases. There are a lot of things that are going into inflation that are causing it that have nothing to do with whether the Fed cuts rates or not. It'll make the stock market go up, but it won't have any bearing. It has no bearing on the real economy. The big picture is disinflationary, maybe bordering on deflation, which is a central banker's worst nightmare. They say, we don't worry about inflation because we'll just raise rates until it goes away. It's debatable, but that's what they think. But deflation, they don't have a formula. I mean, QE doesn't work. QE is a joke. And by the way, when I say that, I should be clear, there's a lot of empirical evidence that's come along since 2008, globally, looking at other countries that have done this, that says QE doesn't work. And so you can do it, it's for show, you can talk about it, but it doesn't cause inflation. I mean, just take the end of the last recession in 2009, not counting 2020, I don't know what that was. I mean, the economy dropped 30% in 2 months, but treating that as COVID-related, turning out the lights, not really fitting in any economic model. But going back to 2009, March or June 2009, the end of the last recession, to the end of 2019, just pre-COVID. 10 years, 10 years. The Fed balance sheet went from $800 billion to $5 trillion. Base money, M0, money supply. $800 billion to $5 trillion. There was no inflation. They couldn't get inflation. Average annual growth for the whole 10 years was 2.2%. Our potential is 3.5 if we do everything right, have good policy and so forth. When you're growing at 2.2 and your potential is, I'll say 3.25, that's what Keynes called a depression. And I've said, I don't have to play the recession game. I mean, I know what they are. But I said in 2007, we entered a depression, and we've been in it for the 17 years since. And guess what? Japan went into a depression in 1990. This is their 9th recession. It is. This is their 9th recession since 1990. What do you call 9 recessions in 30 years? I call it a depression. What does have impact is psychology expressed as velocity. In other words, you can have hyperinflation on a pretty small money supply if the turnover goes to 3, 4, 10 or some big number, but that's psychological, and that does feed on itself. That's more demand side inflation. But the problem with that is supply side inflation tends to self-extinguish. You know, when prices get high enough, they come back down depending on what they are, because people will produce more, solve the inefficiencies in the supply chain. But the demand side inflation has no natural cure. It does feed on itself and grows exponentially. So that kind of psychological change, which I don't see right now, and velocity, which feeds on itself, will give you as much inflation as you want, regardless of money supply. That's why I say that's kind of irrelevant. But you have to factor in geopolitics. They have closed the Suez Canal. The ships are going around Cape of Good Hope, you know, pretty place, but it's a long way from the Suez Canal. The oil will get through, but it'll be delayed, and it'll be more expensive because the transportation costs are huge. The price of the bunkers are going up, and that feeds on itself. So you're disrupting the supply chain again. That's an inflationary impulse. You can get into a debate with smart people. That's not really inflation, it's supply chain. You know, to me, if the price goes up, it's inflation. I grant that there are two different kinds, supply-driven and demand-driven. And your greatest danger is that when the supply-driven inflation, and geopolitics is part of it, leaches over into the demand side and expectations change, and then it feeds on itself and gets out of control. So the short answer to the question is, I don't see a significant decline in the rate of inflation. In fact, I can see the rate of inflation going up, at least for several months, perhaps longer, based on the geopolitics, which means there's no pivot. The most dangerous situation of all, which is the Fed will cut rates if unemployment starts to go up, job creation goes negative, we're losing jobs, et cetera. And then that's a whole other arcane debate about full-time versus part-time and real wages going down. And I always look at the degree distribution. It's like, okay, you tell me an average wage, fine, but I got to average like you and Jeff Bezos, you know, and then that degree distribution is extreme. So you can't even rely too much on the averages, because 90% of the people could be taking a real wage cut in a world where real wages are going up a little bit because a small sliver who don't need the money are going up exponentially. Leaving that to one side, if unemployment gets worse, job creation goes down, et cetera, that's first of all, a sure sign of recession. It's almost the definition. It's a lagging indicator, which means we're really into it at that point. And the Fed would cut. I agree with all of that, but you could still have inflation, and the name for that, as you know, is stagflation. That's the worst of all possible worlds. And go back to 1979, 1980. What was the state of the world? 10% unemployment and 13% inflation. There is no Phillips curve. It's like the terminal rate. I understand Phillips was a prominent economist, and I understand that you can compute it, but the last time I looked, Phillips curve was flat, not much of a curve. But the point being, the Phillips curve is junk. It's junk science, because you can do a quad chart and say high inflation, high unemployment, Or you can have high inflation, low unemployment. Or you can have low unemployment, low inflation. You can fill in all four quads, which means that there's no causality. There is no correlation. And I said 1979, 1980, we had high inflation, high unemployment. According to the Phillips curve, that doesn't happen. 2009 to 2019, unemployment came down and then stayed low, and inflation was low. Phillips curve said that shouldn't happen. But they both did. It's in the data. The actual budget deficit has been running over $2 trillion relative to a baseline of $1 trillion. And you do that for 4 years, you get $8 trillion, or probably close to $10 trillion, which is exactly what happened. The national debt's $34 trillion, but at the beginning of Trump's administration, it was about 21, and then Trump ramped it up to the high 20s, and then Biden took it right to 34, which is where it is now, and the debt to GDP ratio is 125%, highest in history. People are under the impression that it doesn't actually matter. And that is modern monetary theory. It has taken over the mindset in Washington. Hey, look at Japan. Their debt to GDP is 300%. We got a long way to go. Going back to debt to GDP ratio, 125%. Okay, we're there for a lot of reasons, and both parties are in on it. But what does it actually mean? That was the question you asked. We know the answer to that. We've got decades of empirical, we know the answer, but they're just now asking the question. You're right. Oh, gee, is this a big number? And what I say is 34 trillion is a big, scary number, but it means nothing unless you compare it to GDP, unless you look at the ratio. Because I say, if you owe $50,000 on a MasterCard, if you make $500,000, no big deal, you write a check. If you make $20,000, you're probably going broke. You can't get any information out of the $50,000 balance. You have to say, how much money am I making relative to that balance? So now, getting back to debt to GDP, 34 trillion doesn't mean anything unless you put it in the context of GDP, which is how much you're making, in other words, what's your economy actually worth. There is such a thing as a Keynesian multiplier. It's not a free lunch, but it is true that at certain levels of debt to GDP, and I'll take 30% as it, by the way, when Ronald Reagan was sworn in, it was 30%. We took it down from 120 to 30 in the 35 years from the end of World War II to Reagan being sworn in. That was bipartisan. That was Truman, Eisenhower, Kennedy, Johnson, Nixon. It was never a partisan issue. It was like, let's just get this under control. But at those levels, assuming you don't just burn the money, there is a Keynesian multiplier, and so you can borrow $1, spend $1, and get $1.25 of GDP. That actually works. Whether it was money well spent, separate issue. Whether it's sustainable, separate issue. You can borrow $1, spend $1, get $1.25. But the problem is there are diminishing marginal returns. As the debt to GDP ratio goes up, that multiplier goes down. What's the critical threshold, as a physicist would say, even from complexity theory? Where is the point at which it becomes less than $1? So now you borrow $1, you spend $1, but you get 90 cents of GDP. Where's that point? The best answer is right around 90% debt to GDP. That's why the Maastricht Treaty that governs EU fiscal policy was set at 60%. Angela Merkel thought that was way too high, but it was a good cushion to 90. They kind of knew about the 90, at least intuitively, and that was there. 60 is way too high because you're getting too close to 90. Well, we're at 125. I mean, who's at our lunch table? It's Lebanon, Italy, and Greece. Right? That's our crowd. But when you go past 90, it gets worse. In other words, that multiplier gets smaller and smaller. That number was 0.67. We borrowed $1, spent $1, and we got 67 cents of GDP. So to answer your question, do you get GDP? Yeah, we actually had a pretty good quarter of GDP, but we borrowed more than we gained, which means if you're increasing the numerator by $1 and you're increasing the denominator by 67 cents, what's happening? Your debt to GDP ratio is getting worse. In other words, you can't borrow your way out of a debt crisis. You can keep borrowing, you can keep spending, you can keep generating GDP, but the GDP gets less and less and less relative to the $1 you borrowed. The ratio is getting worse. And what's the other consequence of that? Slower growth. It doesn't mean the world comes to an end. It doesn't mean we default the next day. You get slower and slower growth, which is consistent with the depression thesis, punctuated by recessions, which we have along the way. Well, what happens when you actually get into this situation? And they say one of three things. The first one is default. So that's the Argentina case, but that's because they can't print. They borrow in dollars and print pesos. They can't print dollars, so you just default. And you can set your watch by Argentina, like every 8-9 years, they default. Okay, default is one. Second one, a little fancier dress is restructuring, which is what the IMF does. So you don't actually default, but this is what they did with Greece in 2015. Extend the maturities, lower the interest rate, change the terms, smooth it out a little bit, and do a refinancing and keep going. There is no reason for the United States to default because we can print the dollars. There are consequences, but we can print the dollars. There's no reason for the U.S. to conduct a restructuring because we can print the dollars. So we don't need to do any of that. It's really for countries that borrow one currency and print another. Doesn't work. We don't have to do that. So what's the third? Hyperinflation.
Exactly.
Then that's the American
Bingo.
way. That's the American way. If you compare this with family budget, do the math, whatever, take off 6 zeros, etc. This doesn't work, it's not sustainable, we're heading for a disaster, which we are. Why doesn't the Congress get that? Why doesn't the Treasury get that? Why are they on board? Because modern monetary theory says the opposite. They would say, yeah, that's all true, but it doesn't matter. You can print as much as you want. I mean, Stephanie Kelton, she said, we don't even need the U.S. Treasury securities markets. The U.S. Treasury securities market exists as a favor to investors to give them a place to park their money. We don't actually need it. All we need to do is call the Fed, give them wire instructions to Lockheed Martin. She said this, call the Fed, give them wire instructions to Lockheed Martin, send the money for however many F-35s. Why do you need a bond market to do that? The problem with MMT is that they pose questions like that, and most people are stymied. They're like, well, actually, what's wrong with that? Why couldn't you just send the money right to Lockheed Martin? But I'll give you the answer. Every model she uses is a closed system. We don't have a closed system. And these people, and I'll start with Stephanie, but there's a bunch of them, they know what they know. Here's what they don't know. They don't understand foreign exchange markets. They don't understand the euro-dollar market. They don't understand that there are a lot of ways to strike at the US dollar other than defaulting on the debt, which are exchange rates, inflation, some of the things we've been talking about. That's the kind of the masterclass for the people who believe in MMT. And it all goes back to the great Mundell, because Mundell said there are three variables: there's exchange rate, the interest rate, and capital controls. You can pick any two out of three, but you can't, the third one will come back to haunt you. You can't control all three. You can control 2 out of 3. If you fix interest rates and close the capital account, your currency is going to get crushed. Or if you have free exchange rates and an open capital account, forget about interest rates, you're just going to follow the Fed. So he said you can have 2 out of 3, but not all 3. But that's why, to your point, it's not a closed system.
The recent buzz about potential Fed rate cuts stems from market speculation, but the situation is more nuanced. While there are predictions about the Fed possibly lowering rates soon, it's important to recognize that such decisions are based on a comprehensive assessment of the economy, including inflation rates and employment figures. Media headlines often simplify these discussions, but real monetary policy adjustments depend on detailed economic analyses. Investors should consider the broader economic context and not just media forecasts to make more informed investment decisions.